Welcome to ET webinar powered by TransUnion Cibil. Today's session will look at the commercial lending landscape in India, the size of the MSME credit market, and which segments are the growth drivers. We will review the risk levels for these MSMEs and find out whether their delinquencies have peaked out in the last few years. To gain more insights on this and to understand where are these new to credit MSMEs coming from and who are lending to them, we have with us Mr. Vipul Mahajan, Head Commercial Products, TransUnion Cibil. Mr. Vipul Mahajan is responsible for managing solutions related to all types of commercial credit in the country, ranging from a micro loan to large ticket corporates. He also interacts with regulatory bodies, government bodies, and top management in banks to frame opinion on the evolving trends in the commercial lending industry. Welcome, Vipul. Could you please share your thoughts on the current lending scenario and is it in good shape?
Sure. Thanks, Pallavi. So welcome everybody for the webinar on MSME Pulse. To answer Pallavi's question, the lending scenario in India, if I have to use only the delinquencies as a standpoint, is probably not in a very good shape. And that's what everybody keeps hearing about, the corporate loans debt rising through the roof and what's happening in the industry. That's something that we will want to talk about today, and it's part of the MSME Pulse report that TransUnion Cibil has, in partnership with Cibil, has started to publish out for last 2 quarters now. June 2018 is the report that I'm going to use to be able to talk about that. So let's go ahead and dive straight into this. I will want to set some overall commercial lending landscape as a context before we get into MSMEs as specific and how the market there actually looks like. If I have to take March 2018 as a snapshot period and look at how the market in the entire country actually looked like, we had about 54.2 lakh crore worth of on-balance sheet exposure among all banks, NBFCs, everybody put together as far as corporate loans is concerned. If you add, just to give you what's the proportion of the total current debt in the country actually lies as, this number reaches about 67 lakh crore if you include non-fund based facilities. If you include exposures in retail, agri, and lying with ARCs, this number somewhere tries to touch around 100 lakh crore. So commercial loans is a very big market in India from that perspective. It's more than 50% of the entire debt in the country. And within the commercial 54 lakh crores of on-balance sheet exposure, now if you look at between the micro and the SME space, they both contribute to about 30-35% of the entire share of the overall commercial space is concerned. Now, not only that they contribute a significant share, the micro and the SME credit, they're also the ones which is the fastest growing. If you can see in the slide, the cumulative aggregated growth from March 17 to a March 18 period, there was 22% growth observed in the micro loan segment and 12.8% growth observed in SME segment. Contrast this with the large corporate growth of only 5.9%. So not only these are significant shareholders of the entire lending industry, but they are also one of the fastest growing ones. 3.8 lakh crore is the share within the micro space, 8.8 lakh crore share within the SME space. Let me also highlight how the definition of the micro, SME, mid and large corporates actually come into play. We define these borrowers within micro, SME, mid and large based upon their aggregate exposure in the entire lending industry. Again, banks and NBFCs put together. If the exposure is under 1 crore, it's typically called micro loans. If the exposure is between 1 to 25 crores, it's called SME loans. If it's between 25 to 100 crores, it's called mid corporates, and more than 100 crores is large corporates. That's how we typically define. I know these definitions are not 100% sync with how banks or RBI might define based on turnover or investment in plant and machinery. But from time to time, over a period of time, we have had multiple rounds of discussions with IBA and RBI to frame up these definitions. So these are very tested type of definitions, so to say. Now, With that as a benchmark, now let's probably see how the from an overall credit share perspective and how the delinquency on these actually look like. The chart on the left, before you start interpreting too much out of the lines, I will help you break these numbers up. These are gross NPA rates at point of time, at snapshot period point of time for different commercial loan segments, micro, SME, mid, and large corporates. The green line, which is shooting through the roof, is actually the large corporate NPA. 18% NPA rate in the large corporate space. These all are based on amounts, outstanding amounts, and not based on counts by any means. 18% gross NPA rate in large corporate space is a very, very high NPA rate. If you read the balance sheet, latest balance sheet numbers reported by some of the public sector banks who are in the PCA category, you would see for individually some of them, this number might be even larger than the average 18%. So it's a very, very high number, and the impact of this is actually started to come when RBI came up with the AQR guidelines somewhere around in December 2015, after which these large corporate NPA rates actually started to shoot up. You can see within this graph itself for last 8 quarters, the number has actually doubled from 9.2% to an 18% is where the gross NPA rates have actually caught up. Now contrast that with the NPA rates in the micro space, which is the less than 1 crore space. That's where the NPA rates are actually flat, or rather actually reducing if you ask me. And where same is the case with SME, where the NPA rates are either flat or reducing. And if you look at March 16 number, these NPA rates were relatively high for that point of time. For that point of time, 9.2% compare of large corporates, 7.9% of micro loans, and 9.8% for SME loans weren't that far apart. But now, if you look at it with how worse off the debt has become in the large corporate and the mid corporate space, these two lines are actually not that bad. These two books are actually not that bad. So, in a net effect, to summarize these two slides, the micro and the SME space is actually growing the fastest. From an asset quality standpoint, this is the best asset quality that's available in the commercial loan space today. Okay. With that, let's dive into now more details about MSMEs and what's happening within that space, where the NTCs are coming from, whether the delinquencies are expected to rise further, not. Let's get into that. We have broken up the MSME space here even further by much more granular ticket sizes, because some of you on the webinar today would be lending to very specific sides of the house. Some might be in very small ticket, less than 10 lakh, less 15 lakh business loan type of segment. Some might be in a very large 5 crore working capital type of limit type of a setup. So therefore, for everybody's sake, we have actually broken this up granular, starting with less than 10 lakh, 10 to 50 lakhs, 50 lakhs to 1 crore, 1 to 5 crores, 5 to 10 crores, and then 10 to 25 crores. The overall 12.6 lakh crore worth of debt in the MSME space is growing the fastest as the ticket sizes are smaller. And it relates to the point that you saw on the previous slide. Banks have, and NBFCs, all the lending institutions in the country have realized granular lending is actually the best form of lending. So smaller the ticket sizes, lower actually the risk that you would expect, at least from a concentration risk standpoint. The concentration of your debt becomes much, much smaller. Therefore, you can see a very, very high growth rate in the smaller ticket size loans. The micro loans, the very small segment of less than 10 lakh is growing at a rate of 35%. It's a very, very high growth rate. And follow that by 21% in the 10 to 50 lakh space. 50 lakh to 1 crore is going at about 16.3% overall. But the biggest, if I have to say which of these space is the biggest within the MSME as far as size is concerned, it's actually 1 to 5 crore space. It's not the high ticket 10 to 25 crore space. It's the 1 to 5 crore space where the market is very, very crowded, where there are a lot of lenders. and the borrowers both are available. Therefore, the market there is about 3.76 crores and it's growing at a rate of 16.9%. Pretty healthy credit growth there. Now let's contrast this with how the delinquencies are faring up across each of these segments. The delinquencies here have a very unique trend here. There are three trends in this NPA rate, gross NPA rate, again the same thing slide. The less than 10 lakh segment, the blue line, is very high NPA rate, and that's actually one of the anomalies in the overall the entire slide. I'll tell you why. Less than 10 lakh is primarily driven by public sector banks giving their Mudra loan segment. So within the Mudra loan segment, if you see less than 10 lakh space is growing at a rate of 35% and has a very high delinquency rates. The denominator effect is also helping probably to reduce the NPA rate, but it actually is not reducing. The NPA rates are actually relatively very high. So that's a space of the Mudra loan where most of the public sector banks are actually facing a lot of stress in that segment, why the NPA rates are so high. But if you ignore that line for a minute, then the NPA rates are increasing as per the ticket sizes in a very natural fashion. Lower the ticket size, lower the delinquency rates. 10 to 50 lakhs has the lowest delinquency rates of about 8.3%, follow that by 50 lakh to 1 crore, 8.2%, then 1 to 5 crores, then 5 to 10 crores, and then to 20 to 25 crores. It increases in a very gradual fashion. But the other trend that's emerging here, if you look at across all ticket sizes, you can see a small spike after September 16 till December 16 quarter, which is primarily can be related to the demonetization effect, where some of these MSMEs actually faced some stress in paying back their debt. And the stress was more faced in the smaller ticket size segments and in the NBFC space than in the larger ticket size segment and the public sector and private sector bank space. Now, after that period has got over, the NPA rates are actually reducing or flat for all segments. So the hypothesis that MSME is probably the best asset quality in commercial lending space available even holds true when you break it up even further by micro, small, and very small type of companies. The delinquencies there are actually not rising; they are pretty much stable, and it's obviously one of the fastest growing book that we have. Okay. Okay, with that, if I move and I want to bring now some views of the lender types. The views on the lender types now talk a very different story here. And it's a story of how the market is changing so rapidly fast in the MSME space. The market, these bars are basically the proportionate market share at each point of time among different type of lenders. The orange or red shade color is actually public sector banks. The yellow is private sector banks. Blue at the bottom is NBFCs. And green on the top is all the others, which will be the foreign banks, some of the RRBs, cooperative banks, and different merchants. Public sector banks have lost their market share from 60 to 50%. It's a 10% market share drop. It's a huge drop within a period of 2 years. Their market share is not only picked up by private sector banks alone, that has also been picked up by NBFCs and the other segment too. So these are those type of public sector bank relationships which may be affected because of a PCA, which may not be affected because of the PCA scenario coming into picture. See, PCA is a very recent phenomenon if you look at it. PCA is probably a 2017 phenomenon, calendar year 2017. But within 2016 too, you can see a market share drop from 60 to 57%. It wasn't as steep as after the PCA regulations actually got tightened up, and from 57% you can see a 50% market share drop. So this trend was continuing, but I believe after the regulation came in, it became even sharper. Okay. Now, let's keep that in mind while we look at it. Who is and what's happening in the NTC space of the for MSMEs. We will probably put some more views about the how the lender institutions are viewing the MSME space in the upcoming slides. But just to bring in a new angle here about how the NTCs are faring up. The NTCs, the way we define it, is the new to credit. Basically, since TransUnion Cibil hosts data for about 1.5 crore companies in the entire country. And of the 1.5 crore companies that we have in the entire country, we have a unique identification number internal to TransUnion Cibil, which is agnostic across banks. So I can see whether an MSME had ever taken a credit from any type of institution. So therefore, the NTC view from TransUnion Cibil is a very, very unique view. And the way we are able to produce that, we have separated here the slide for MSME NTCs in less than 10 lakhs in 10 lakh to 1 crore segment and in the 1 to 10 crore segment. So in the 10 lakh to 1 crore segment, the slide on the left, what we're trying to say of all the NTCs that have come into the market. And this is a period of last year, 2017, of all the NTCs that came into the market, out of them, 70% of them continued to remain in the market without turning into an NPA and stayed in the same ticket size bracket. The good part is 4.3% of them actually enhanced their size of credit and went beyond 1 crore, something like in 1 to 10 crore space. 10 crore plus is just 0.1%, maybe one or two cases. That's ignorable. The best scenario here is actually the ones that turned NPA. Only 4.3% of the NTCs that come into the 10 lakh to 1 crore space ended up turning as an NPA. And as you can see in my previous slides, the 10 lakh to 1 crore segment has a running NPA rate of about 7-8%. And this NPA is viewed over a period of 18 months. So in 18 months, if about only 4.3% of, and we see the peak of NPA rate happening somewhere around 3 years time period. So net effect, the story that I want to put across and the hypothesis that I want you to take back after today's webinar is the NTCs are not that bad a credit what the banks and NBFCs are lending today. It's usually viewed as NTCs might be the more risky ones. It's difficult to underwrite them, but in the MSME space, they probably behave the same, if not better, than any existing to bank borrower. A similar trend can be observed in the right side of the chart also between the 1 to 10 crore segment, where the NTCs turn NPA only 4.3% number of times. The only thing that might be slightly higher over here is the exits that we see. Exit here is a very unique phenomenon, again unique to TransUnion Cibil because we can host data across. Exit is a system exit. Exit is not a bank exit. That they have exited the formal lending space by any bank or any NBFC. So you can see about 19 or 21% of them they were NTC before. They were in need of funds. They got the funds from one of you. One of you funded them. Their need got fulfilled within 18 months. They paid back their debt in full and cleanly and exited the market also. So you can also view it in another way that only 80% of the NTCs that come in to take the loan are going to be there for good. 20% of them are already self-funded, very well funded. They have only come for a very, very short-term credit. Once that's over, they're going to go back. Okay. Now with that view, let's see who's funding these NTCs and where these NTCs are actually coming in from. This is the share of, it's a slightly lot of numbers on this slide. Let me break this down for you. That all the bars are again proportionate share among all lender types. The color code are the same that you saw on the previous slides. The red and orange is public sector banks, yellow is the private sector banks, blue is NBFCs. So NBFCs and fintechs are all considered the same as far as bar labeling goes. So if you're one of the fintech companies and you do lend, you will be under the same blue bar. These slides talk about the proportionate share of the NTC lending done in any ticket size space. So the first two bars, the leftmost two bars, are actually the bars for the proportionate share of the NTC lending done in the less than 10 lakh space. About 78% lending in H1 2016, and these H1 are actually calendar halves. In H1 2016, 78% of the lending done in the less than 10 lakh space was done by the public sector banks, which got reduced very minusculely to 75% by H2 2017. But you can start seeing the sharp shift in the NTC lending done as the ticket sizes increases. Let's just go to the rightmost extreme in the 5 to 10 crore, which is the slightly higher ticket size space. From 46%, public sector banks dropped to 30%, and the private sector banks jumped up their share from 32% to 49%. So the whole NTC, while they were very, very heavily dependent upon public sector banks, I think the dependency is reducing very fast. And especially if the ticket sizes are slightly larger, where private sector banks probably are more willing to go through the process of underwriting an MSME, which so that at least the size of the loan is actually slightly large. They're highly interested in funding those, and probably they have figured it out with all digital information, what you call that, overload happening in the MSME space with GSTIN and various other information coming in. The NTC as a space, my previous slide talked about saying that they are not that bad asset quality. This slide talks about the share shift that's happening among banks, where most of the NTCs are now getting funded by the private sector banks. The dependency on public sector banks is actually reducing as we speak, at least in the high ticket size space. Okay. Okay, with that, I want to talk a little bit about some of the macroeconomic trends that have impacted the MSMEs in the recent past. There have been three macroeconomic events, rather policy/macroeconomic events that have happened in the recent past related to MSMEs. First was the demonetization that happened in the period of October 16. Second is what the GST implementation, which came in the month of July 17. And third is the RBI guideline for MSMEs enrolled in GST can not pay back their debt by 60 days, the circular which came in the month of Feb 2018. The Feb 2018 circular impact is not so visible right now in this slide. We are yet to probably quantify that impact. But these are the three major events that we are tracking which have impacted the MSME space. The chart that you see is the credit exposure by all the MSMEs in different ticket size space. So yellow is 10 lakh to 50 lakh, red is 50 lakh to 1 crore, green is 1 to 5 crore, and blue is 5 to 10 crore ticket size segment MSMEs. So MSMEs which fall in these ticket sizes, what was their average outstanding balance at any point of time? They all are pegged to 1 for December 15. All of them are moved back and pegged to 1. So if their December 15 average outstanding is considered as 1 rupee, how did that 1 rupee moved over a period of time? You can see before demonetization, all of them were increasing the size of their exposure. All of them are. Even if it's a working capital limit, people are either getting more limit, hence drawing down more. And these are all aggregated exposures at the borrower level. So if a borrower has 5 limits, it's the aggregate of 5, all of the 5 put together. So you can see as the ticket sizes are increasing, their growth rate is also even higher before the demonetization actually kicks in. Once the demonetization hits, they're obviously flushed with the cash that they have in hand, which they want to dispose of further before drawing down further from the bank credit. All the lines see a drop. The yellow line, the lower ticket size line, actually got the most impacted, which dropped the most steeply. It did not rise that steeply, but it fell very, very steep. They were the lower ticket size segments were the most impacted in the demonetization phase. Then after that, some stabilization, and we see actually the GST coming in. With the GST coming in, you can see again a small dip in the outstanding exposures that these MSMEs have. This was primarily because of the working capital stress that they faced. They probably were not getting adequate GST related bills and everything to process that further. But the moment that early days, the first quarter of the GST passed, you can see a sharp increase in the exposures that these guys were having. And now today, they are all back and above the previous December 15 levels. And the fastest recovery has seen in again back in the yellow line, the lower ticket size segment line, which has actually seen the fastest recovery. So in the net effect, demonetization, the utilizations reduced. After GST for a brief period they reduced, but immediately after that, the September 17 quarter, they got hugely benefited by the whole GST architecture, and suddenly their use of credit is actually increasing. And you can sync that up with the earlier slides that I spoke about on the NPA rates, that how the delinquencies have actually stayed in control while the utilization rates are increasing in this slide. So that's on a larger level effect. On a early, I just want, while it's not on the slide, but I want to leave you with the early thought saying that the Feb 18 circular of MSMEs being able to revolve, not revolve, actually delay their debt by 60 days, doesn't seems to have a very, very major impact. While we were very worried about the CMR 7, 8, 9, and 10 type of companies, the poor credit score companies, to be able to flow forward very, very fast. We are not seeing that major impact because of that guideline, but we are yet to put a formal results on that. Yeah. Last few points that I want to cover upon is how the acquisition today in the country is actually happening. This slide now we spoke about what the current scenario of the debt today in MSME space looks like. Was the size, was the delinquencies, was the impact of economic events. This actually talks about what's the new book that's getting booked today. So it's from the last calendar half of 2017. Of all the acquisitions that were made in the country in the MSME space, we have a Cibil MSME rank, a credit score for MSMEs. It's just like a Cibil score for MSMEs, which ranks MSMEs between 1 to 10. CMR 1 is the best and CMR 10 is the worst. Most of you already use this in your underwriting. Just in case you don't, there is a PD probability of default dedicated across each CMR rank, CMR 1 to CMR 10, and it increases exponentially as the CMR ranks increases. What this slide actually tells you is that the number of loans that were given to MSMEs in the half of 2017, which bank did what percentage of lending in what CMR grade. So the new private banks, of all the MSMEs that they lend to, 5% of them end up being CMR 1. Now let me mind you here, CMR 1 is a very difficult rank to get. Therefore, the overall percentages are also very low. The overall proportion of private sector banks in the CMR 1 to 3 segment, which is considered to be the best segment, is about 47%. It's very high. Compared to the public sector banks of about 37%. Now here is the key highlight. The old private sector banks lending of about 36% is very close to the public sector banks averages. You can see the yellow and the red line being very, very close to each other. Whereas the NBFCs, I think NBFCs are mastering the space of the mid-level credit, which is a CMR 456, which is not a very, very cleanly and extremely good credit and extremely poor credit. These are right in the middle. That's where the most of the NBFCs actually, play the best. They get the best rates to be able to lend to these type of customers, identify the best customers, and be able to make the most out of it. So on a nutshell basis, the lending in the country has been happening at a fairly decent risky bands, and is primarily most best credit is taken up by the private banks. The middlemost credit is actually taken up by the NBFCs, and the PSUs and the old private sector banks have a pretty much similar type of a credit, which probably are lying to the rightmost extreme, which is the the not so good credit extreme. Okay. Okay, this is the last slide that I want to then probably take up few questions if somebody has some. This is the last slide that I want you guys to leave some key highlights with you today on which locations are doing what as far as the CMR ranks and the proportion of them goes. The how the slide is actually made is CMR 1 to 3, as I said, is the good rank, and 7 to 10 are not so good ranks. What we have done is we have mapped all the locations. So left side has some of the bigger locations and right side has some of the smaller locations. The locations in a 2 by 2 matrix, with cities like Ahmedabad having very high CMR 1 to 3 proportion. So they are probably running at a 59% CMR 1 to 3 proportion and a very low CMR 7 to 10 proportion. They are running at about a 14% CMR, 7 to 10 proportion. So Ahmedabad as a credit market, the message on the slide is if you go to Ahmedabad, the probability that, and you randomly pick up an MSME, the probability that you will find a good MSME is much higher than probably a city like Chennai, where CMR, the good grade CMR are less and the worst grade CMR are actually higher. So I'm gonna leave you with this slide for probably a minute so that you can read through the cities that you are interested in. Where on the right side of the slide is probably Rajkot, Panipat, Indore, Vadodara being on the green quadrant, and Guntur, Tirupur, Patna, and Ernakulam being in the red quadrant. And in this side, Chennai, Hyderabad being on the red quadrant, Bangalore just on the edge, and Ahmedabad, NCR, MMR being on the green quadrant on an overall basis. Okay.
Vipul, that was a very insightful conversation. We've received a lot of questions and we are going to take up few of them now. So first question that we've received, it talks about the NPA rates of private banks. They're significantly lower than the PSU banks. So what are the possible factors behind the difference in the NPA rates?
So the NP rates for that's a good question. It's part of our MSME Pulse report. I didn't have one of the trends today, but the private sector banks run in MSME space at NP rates probably 1/3 of the public sector bank space. And one of the key reasons why they are able to maintain that is one of the slides that I covered here, saying that their acquisition quality in itself is a much better, from a CMR rank perspective, which we can say they underwrite much better credit than the public sector banks. I think that's one of the reason why when you onboard better quality customers, you end up having a better credit also. And then there is a concept of collections and various different things, which I'll not get into today. But from an asset quality standpoint, they're underwriting a much better credit. I think that's a quick answer to that question.
Okay, we'll move on to the next question. Is the micro and SME definition in the report same as the RBI definition of MSMEs?
So that's the point that I briefly covered, saying that RBI uses the investment in plant and machinery as the definitions primarily. We use the definition on the aggregate credit exposures being in certain range. So micro being less than 1 crore, 1 to 25 being SME. You can roughly make 5 times of this since RBI allows 20% of the turnover as the exposure. So you can roughly say micro will be 5 crore exposure, SME will be 5 to 125 crore exposure, that type of zone. But they are not 100% aligned to RBI definition, but they are very, very well tested to make your proxies on.
Okay, so there's another question. Is the high growth in the sub 10 lakh segment due to government schemes like Mudra? What do you have to say on that?
Yes, that's primarily driven by a lot by the Mudra loans, the less than 10 lakh segment. It's public sector banks, as I also shared that within the NTC space, they lend in less than 10 lakhs segment as high as 78% of the NTC is contributed by public sector banks. I'm not saying of less than 10 lakh NTC is 80%. That's not the statement. Statement is within public sector, within the less than 10 lakh NTC, 80% is taken up by public sector banks, and that's driven a lot by Mudra loans.
Okay, we'll take a few more questions. Yeah. So the next question is about the NTC portfolios. What is the aging of NTC portfolios at which the NPAs are at 4.3%? What if we look at these NPAs with a lag of 12 months?
So this aging that you saw, 4.3%, is an 18-month aging that we saw. If I'm not sure what you mean by the lag of 12 months on an NTC, but if I compare this with an existing to book credit and look at their 18-month NPA rate, this will probably end up being slightly higher, if not the same. So 4.3% on an NTC in an 18-month window is a very, very good NPA rate. The Cibil MSME rank, 4.3% within a 12-month window actually lands up somewhere around CMR 4 or CMR 5. So it's a very, very good credit from that perspective.
Okay. So there's another question that we've received. Does the rate of increase of NPA means that there is a clear bubble growing here across the segments? Also, is that NBFCs or growing lenders will have to be washed out for their NPAs, as right now because of transition there is a denominator gain for them. Also, portfolios look low on delinquent. That's quite an elaborate one. So what's your take on this?
Yeah, I only got the first parts of asking whether there is a bubble actually being built up. Okay. Okay. So let me answer the bubble one first. I think that's the bigger and the more important one. See, we have recently done a concept called iceberg on all the NPAs that are there in the country to understand the concept that you're asking about the bubble. And our insights show that the stress is actually in large corporates and somewhat in mid corporates. The retail is very good. There is something happening in retail on over leveraging, but that's a very, very minuscule point. The delinquencies are very, very low. The what you call that, the leverage is also not increasing that sharp, but it is increasing. But net effect, retail is good, MSMEs is good. The stress is within the large corporate and the mid corporate. Now, the iceberg study has helped us understand that these growing lines that you see on the slide right now, the NPA rate shooting up through the roof for large corporates, I think the peak is somewhere the September quarter. After that, you will not see that sharper rise. And it is a lot to give back to the RBI circular of the Feb 12 circular 2018, Feb 12 circular, which ensure that most of the stress actually gets revealed. So to the bubble answer, I don't see it expanding any further. It's going to be still where it is. And from next 12 months down the line after that, it's all going to start moving towards a much better NPA asset quality. I'm sorry, I didn't get the NBFC part of the question. If I can quickly. Okay, so NBFCs or other new lenders will have to watch out for while taking over the credit from other existing bankers. You know, whether private sector bank or whether a PSU bank. If you're doing an NTC type of a lending, then you're obviously very cautious, being able to take care of various different things. But this is a time where you can see all the NPA lines being very, very high. Ensure that you're not buying another lender's bad credit. Just be careful on that fact. It's an easy thing to miss out on, but be very careful on that fact. We do see. Okay, I'll leave you with one very important fact, then we can go to the next question. We do see if a credit in MSME space is given without checking the commercial credit report, the company's credit report, the NPA can be 5 times higher in 12 months window. The probability of NPA is 5 times higher. Just be careful on that.
All right. So we'll move on to the next question. How are NBFCs able to underwrite better quality loans? Is it because of using the CMR ratings alone?
So CMR does help a lot to be able to underwrite faster and making sure the asset quality is in control. But obviously that's not the only way that they end up lending further. They do a lot of surrogate lending, which banks actually don't go down that path. you know, one of the very, it might be very bottom of the pyramid NBFC example, but lending to a vada pav stall by just the guy doesn't have any receipts, any paperwork, but he will have the bill that he pays to the vendor where he buys potatoes from. He will not buy potatoes like us 1 2 kgs. He'll buy probably 20 kgs potato. Is he buying 20 50 kgs per day? So NBFCs do a lot of surrogates, pick up surrogates like that, which banks never end up picking up, to be able to understand the credit a little probably better than what banks can do from the standard, where the standard paperwork is not available. Standard paperwork is extremely important. So CMR does help. They are highly adopted on Cibil MSME Rank. That's a very quick way to understand the risk. But also the surrogate lending that they end up doing, I think they use their surrogates well.
Okay, we'll take a few more questions. The next one asks about the NTCs. Does Cibil ratings include NTCs as well?
No. So Cibil MSME rank currently, the rank that you saw here, it requires minimum 1 month of credit vintage to be able to come up with a rank. So currently it does not include new to credit. On an overall basis, we see new to credit about 20% of all the lending that happens in the country. So that the rank doesn't cover it.
Okay. What is the CMR band-wise distribution of the overall portfolio?
Okay, so I skipped one slide. I have one slide to quickly answer that. This is the band-wise distribution of overall portfolio as of March 18 if we exclude existing NPAs. If I include existing NPAs, the CMR 10 band, which currently looks at 0%, will increase. Some of the 8 and 9 will also increase. But on a good credit, this is how the existing portfolio actually looks like. So it's a very fat 2, 3, and 4, especially 3 and 4. They 2, 3, and 4, and these bands actually end up making more than 70% of the overall credit in the country. So currently, just to also leave you with a thought, 2.7 million. So 27 lakh companies today in the country are eligible to get a Cibil MSME rank.
Okay. Okay. So the next question is more so about the portfolio behavior. The question isn't the seasoning of the MSME loans of just 18 months too early to judge the portfolio behavior?
No, I don't think so. Too early to touch. If the question is whether 18-month seasoning is enough to judge portfolio, if that's the question, I don't think 18 months is too short a window to judge. We have seen a peak of the behavior happening. So a study was done internally where we saw that after what point of time your risk doesn't expand very, very fast. It's actually 3 years. That point is actually 36 months, 3 years. But 18 months also you get to see a lot of things that you have to see.
Okay, so 18 months is not that short. We have the next question. You say that the exit rate of NTC is at 20%. Do we have the exit rate of ETC with whatever definition of ETC you have?
No, it's a good question, but I don't have the clear-cut answer. How many existing to bank borrowers exit? We are planning to cover that in our third edition of MSME Pulse, but I don't have currently the answer to that question.
We'll look forward to the new report. The next question is about the delinquencies of business loans in MSME segment. What is the current status?
Business loans, if you mean the unsecured credit in the MSME sector, it is ideally going to be in the lower ticket size space. So we don't classify, while we have a business loan classification, but sometimes even the term loans are also given without security, and it gets muddled up with the reporting happening across lenders, across banks. I will give you the answer based on the ticket size segment. If I say less than 50 lakh is the business loan segment is what it is, then the average is about 8.2%, 8.3%. The average delinquency rates in that space.
All right. So it's time to wrap up now. We received a lot of questions, but due to the time restriction, we'll have to cut it short. Thanks a lot, Vipul, for your time and for this
Great,
interactive
thank
session.
you. Yeah, thanks for your time. Thanks everybody for joining in today.